Welcome. Today we're doing a deep dive into SAP's Q3 2025 results and their updated outlook.
Yeah, we'll unpack the numbers, the market reaction, and what their guidance really tells us.
Let's jump right in. Q3 financials. Kind of a mixed picture, wasn't it?
It really was. You had total revenue climb 7%, hitting about $9.08 billion.
Which sounds okay, but it actually missed analyst forecasts slightly. They were expecting, what, $9.11 billion?
Exactly. A small miss on the top line, but then you look at the profit.
Yes. Profitability was the big story here.
Absolutely. Adjusted earnings per share, the EPS, came in at 1.59.
And that was way above expectations, right? Like a 37% jump year over year.
Huge jump. Analysts were looking for maybe 1.49, so a really strong beat on the bottom line.
Driven by efficiency, it seems, and the non-IFRS operating profit reflected that too.
It did, up 14% to roughly $2.57 billion.
Maybe quickly explain non-IFRS for anyone wondering why that specific measure gets highlighted.
Sure. It basically means they adjusted the standard accounting figures to take out certain temporary or non-operational costs, things like restructuring or maybe some acquisition impacts.
So it gives a cleaner view of the underlying business performance.
Exactly. How the core operations are actually doing month to month, quarter to quarter.
And that non-IFRS profit, you set up 14%.
Yeah, and even better, 19% if you look at it at constant currencies or at CC.
Right, another important term, stripping out currency fluctuations.
Precisely. For a global company like SAP, exchange rates can really swing the numbers around. Constant currency gives you that sort of apples-to-apples comparison of the actual business growth.
Okay, so solid profit, slightly soft revenue. Now, the engine room, the cloud, how did that perform?
Well, cloud revenue hit almost $5.3 billion. That's up 22%, or a really strong 27% at constant currencies.
Still strong growth then. But there's a but coming, isn't there?
There is. Even that impressive 27% growth slightly missed what analysts were predicting. They had penciled in about $5.33 billion.
So another slight miss, even on the core growth area. Interesting pattern.
It is. But, digging deeper within the cloud numbers, the cloud ERP suite, that was really motoring.
The core offering, rise with SAP territory.
Exactly. That part was up 26% or 31% at constant currencies, reached nearly $4.6 billion.
So that specific strategic push to get customers onto their cloud platform, rise with SAP, that seems to be gaining serious traction.
No doubt. It confirms customers are adopting these big strategic solutions. It's all about moving away from those old upfront licenses.
And we saw proof of that shift, didn't we? The software license revenue.
Plummeted down 43%.
Wow, 43%. That's steep. But you're saying that's actually a good sign, in a way, because it means the transition is working.
In this context, yes. It shows they're successfully pushing people to the subscription model, which investors prefer for its predictability. The key is that the cloud growth is more than making up for that planned decline.
Okay, makes sense. But now we get to the real point of concern for the market, it seems. The current cloud backlog, CCB.
This is the big one. It's basically the guaranteed future revenue they already have under contract. Think of it as the pipeline.
The fuel gauge for future growth, as you put it earlier.
Right. And the number itself looks good on the surface. Grew 23% to almost $19 billion.
23% growth in future contracted revenue sounds fantastic. So what's the problem?
The expectation game. Analysts had forecast 27% growth for that backlog.
So a 4 percentage point miss on expected future growth.
Exactly. And that seemed to overshadow everything else for investors.
So just to be clear, a huge realized profit beat gets less weight than a miss on anticipated backlog growth.
That's pretty much what happened here. It tells you the market is laser-focused on the acceleration story. Any sign that future growth might be slowing down even slightly gets punished, especially when a stock is priced for perfection.
Okay, so that explains the disconnect between the results and perhaps how the executives felt about the quarter. How did they frame it?
Well, the leadership commentary was very positive, very confident. CEO Christian Klein called it a great quarter.
Really? Despite the misses?
Yeah, he focused on the 27% constant currency cloud growth, claimed they were gaining market share, highlighted the whole business suite adoption, including AI and the data cloud stuff.
And he sounded optimistic about the future.
Very. Talked about a strong Q4 pipeline and feeling confident about hitting their 2026 revenue growth ambitions. Pure confidence.
And the CFO, Dominik Asam, he's usually focused on the operational side.
He was too. He talked about the strength and agility of their model, how they maintained momentum through disciplined execution, and a sharp focus on profitability and cash flow. Even acknowledged the uncertain macro backdrop.
So C-suite view. We're executing well, growing strongly where it counts, managing costs, and feeling good about the future.
That's the message they put out.
But the market reaction, not so good. Stock dropped over 2% after hours. Why such a disconnect?
It boils down to that future uncertainty, amplified by the backlog miss. Analysts immediately flagged two main worries.
Oh, what were they?
First, external macro risks. Specifically the idea that tariff disputes or just general global trade friction could be delaying big deals.
Especially for SAP, with their huge manufacturing customer base. Those companies would be sensitive to tariffs.
Exactly. Big manufacturers might pause or delay signing massive multi-year transformation contracts if they're worried about trade issues.
And a delayed signature immediately impacts that future backlog number, the CCB.
Precisely. Which leads straight into the second and probably primary concern. Just the sheer disappointment over that CCB growth coming in at 23% instead of the expected 27%.
So the market connected the macro dots. Potential tariff delays plus the softer backlog equals higher risk of slower growth ahead.
That seems to be the logic. That 4-point miss became a tangible sign that those macro headwinds might actually be starting to bite, making the future look a bit murkier than expected.
Right. Which brings us neatly to their updated guidance for the rest of 2025. It sounds like they tried to address this tension head-on.
They did, and it's quite nuanced. They updated the outlook for cloud revenue, operating profit, and free cash flow. And it shows a clear strategic choice.
What was the choice?
Essentially, they signaled maybe slightly slower top-line growth, but much stronger bottom-line results. So for cloud revenue, they guided towards the lower end of their previous range.
Okay, acknowledging the potential for slower deal closures affecting revenue.
Right. The range was 21.6 to 21.9 billion, so they're saying expect it closer to 21.6 billion now. Still represents 26% to 28% constant currency growth, mind you.
But then on the profit side,
They flipped it.
Yeah.
Non-IFRS operating profit is now expected towards the upper end of its range, 10.3 to 10.6 billion.
and free cash flow guidance was also nudged up slightly.
Yes, to 8.0, 8.2 billion, up a bit from roughly 8.0 billion before.
So the message is, okay, macro factors might slow the big deal signings a bit, impacting the very top line and backlog slightly, but we are running so efficiently, we'll actually make more profit and generate more cash than we thought.
That's exactly the message. It's a pivot towards profitable, efficient growth, maybe acknowledging that hypergrowth is harder in this environment. They even explicitly guided that CCB growth would likely decelerate slightly through 2025.
And this confidence and efficiency isn't just talk, right? They linked it directly to their internal use of AI.
Absolutely. They presented this as the strategic underpinning. Their ability to unify apps, data, and AI across the business is allowing them to find serious internal efficiencies. They gave some pretty striking examples.
Yeah, let's touch on those. They quantify the impact.
They do. In engineering, they mentioned something like 70,000 code changes per month are being checked by AI. Think about the speed and quality impact there.
Huge. Faster development, fewer bugs reaching customers.
Right. And in their sales or go-to-market teams, they reported over 40% productivity gains from using AI for things like deal reviews.
So faster sales cycles, potentially closing deals quicker, even if the initial signing takes longer.
Could be part of it, streamlining the internal process. And then there's customer support.
What was the impact there?
Up to 30% of initial customer support requests solved by agentic AI without human intervention.
That frees up human agents for complex issues and saves a lot of costs.
A massive amount. They actually put a number on it saying these AI-driven efficiencies are delivering value in the triple-digit millions.
Okay, so those aren't just vanity metrics. They're translating directly into bottom line improvements, justifying that higher profit and cash flow guidance.
It seems so. It shows they're leveraging their own tech effectively.
One last point on the result, the regional picture for cloud growth. Was it strong everywhere?
It was generally strong, but particularly so in APJ, Asia-Pacific, Japan, and EME, Europe, Middle East, Africa. The Americas was described as solid.
Any specific countries called out?
Yeah, they highlighted Brazil, France, Germany, India, Italy, and South Korea as having outstanding cloud revenue growth. So broad-based success globally.
Okay, so let's try and wrap this up for you, the listener. What's the key takeaway here?
I think the core tension is really clear. You've got SAP demonstrating strong profitability, excellent cost control, and efficiency gains, largely thanks to AI. And they're confident enough to raise profit and cash flow guidance because of it.
That's the positive side. But the flip side
Is the market's worry about future growth momentum. The slight misses on revenue and cloud revenue, and particularly that lower than expected cloud backlog growth, spooked investors. It signals potential headwinds from the macro environment, slowing down those big-ticket deals.
So SAP seems to be making a strategic bet, prioritize profitability and cash flow, even if the absolute top-line growth rate moderates slightly in the near term due to external factors.
Exactly. It raises a really interesting question, doesn't it? In this kind of environment where maybe deals are just inherently lumpier and slower to close, is focusing on operational excellence, efficiency through AI, and maximizing profit actually a better sign of health for a giant like SAP than just chasing pure revenue growth at all costs?
That shift from maybe growth at any cost to profitable, disciplined growth, as CFO Asam emphasized, might be something we see more of across the enterprise software landscape. Definitely something to keep a close eye on as we head towards 2026.